Surprisingly, decent performance delivered, or at least better than expected performance delivered by Tata Motors for the quarter gone by. Revenue was a beat as well. We were expecting 28,000 crores. They managed to hand in close to 32,000 crores in the revenue figure. Loss came in slightly more than what we were expecting at 8,444 crores. But the good news, or the highlight of their result, was the fact that there's no EBITDA loss. They were actually EBITDA positive for the quarter gone by. While it was a very small figure of 682.7 crores, but still an EBITDA positive in a tough market like this definitely will augur well for the company and the investor sentiment as well. Hopefully, margins have come in at 2.1% versus 4.6%. We all know about the kind of headwinds that the entire industry has been witnessing because of a complete lockdown in manufacturing and in sales. But despite that, what has really worked or helped cushion the operational performance for the company is their very, very stringent, in fact, quote-unquote ruthless cost-cutting measures or cost control measures, according to Mr. P.B. Balaji, the Group CFO of Tata Motors, who told us that it is these measures that have paid off and have helped them sort of cushion their margins performance as well, helping them stay EBITDA positive despite all the difficulties, despite all the headwinds. The CEO of the company has also given a couple of forward-looking statements. They see some disruption due to intermittent shutdowns and supply chain bottlenecks for the domestic market. They witnessed some green shoots, however, for the PV segment, primarily because of the pent-up demand in certain pockets and certain markets. So PV is definitely starting to show some signs of revival ever since they've started opening up. Even on the media call, Mr. Balaji did say that by the end of the first quarter, they started to witness some healthy and encouraging signs of demand recovery coming by in the passenger vehicle segment. They're hopeful for a full recovery of the CV industry by the end of this fiscal, because right now, looking at the way things are, it will take some more time, perhaps 4 to 5 months more, for the CV cycle to at least start turning around. There are a lot of challenges. Firstly, there's BS6 cost increase, there's low GDP growth, financing issues within the CV sector, which is not which is keeping financiers very wary and very risk averse at this point in time for lending to CV players or fleet owners at this point in time. So it will take a few months more to start recovering for the CV segment. Cargo segment within the CV space is still severely impacted. Mr. Balaji said it out loud that they're awaiting the GDP turnaround for demand to pick up there. So until and unless the macros are in place, the CV segment will continue to be significantly and severely impacted. Talking about JLR numbers as well, the revenue was definitely a beat as far as our expectations or most street consensus estimates are concerned. It was down 44%, but given the way or the quantum of the volume decline that JLR saw of over 50%, the revenue figure of £2.9 billion is actually better than estimated. They have given a negative EBIT of 13.6%. The loss before tax is at £413 million. JLR, well, the management is saying that the cash position is better. Free cash outflow of about close to £1.5 billion, which includes 1.1 of one-time working capital, which unwound, and it's about £500 million better than what they had guided for. So they've done a lot of cost control measures, and they've spent only where absolutely necessary as far as even JLR is concerned. 98% of JLR's dealers are functional. They're seeing a good month-on-month improvement in most of their markets across the world. So they're quite positive on that trend to stay. China market is also opening up quite well. The early demand trends there are quite healthy and encouraging as well. So they do foresee a good ramp up in JLR volumes going ahead. They do not want to give any forward-looking statements or give any profitability expectations at this point in time till things normalize globally as well as locally. But overall, I feel the performance and the commentary is better than expected. It is not a very gloom and doom scenario as the street was anticipating for JLR. But yes, it does set them back again by a few quarters. They will have to be, or they will have to continue to be more aggressive and ruthless as far as their cost targets and cost spends are concerned. But let's see how the stock opens up. This is how the numbers play out.